Imagine your friend wants to open a lemonade stand, but she needs $100 to buy lemons, sugar, cups, and a table. She only has $20. So she asks you and three other friends to each chip in $20. In exchange, she gives each of you a little paper certificate that says you own 1/5 of this lemonade stand. That paper is basically a stock. A stock is just a tiny piece of ownership in a company. When you own a stock, also called a share, you literally own a sliver of that business. Its tables, its recipes, its future profits, all of it. Real companies like Nintendo, Apple, or Coca-Cola do the exact same thing. Except instead of five friends, they have millions of people who each own little pieces. So why do companies do this? Because growing a business costs money. If Nintendo wants to build a brand new game console, they need cash up front to design it, build factories, and pay engineers. Instead of borrowing all that money from a bank, which would mean paying it back with interest, they can sell pieces of their company to the public. The people who buy those pieces become shareholders, and the company gets the money it needs without owing anyone a loan. It's a trade. The company gets cash, and you get a slice of the business. Now here's where it gets interesting. Those little ownership pieces can be sold to other people. If you bought a piece of the lemonade stand for $20 and a month later the stand is super popular and making lots of money, someone might offer you $40 for your piece. If you sell, you just doubled your money. But if the lemonade stand starts losing customers because a new ice cream shop opened next door, people might only offer you $10 for your piece. That's the basic idea of how stock prices move up and down. They reflect what people think the company is worth right now and what they believe it'll be worth later. Good news, a hit product, growing sales, pushes prices up. Bad news, a scandal, falling sales, a recession, pushes them down. The place where people buy and sell these pieces is called the stock market. Think of it like a giant online marketplace, kind of like eBay, but for ownership slices of companies. The two most famous ones in America are the New York Stock Exchange and the NASDAQ. When you hear someone say, the market went up today, they mean that on average the prices of lots of company shares went up. The market is open during business hours on weekdays, and prices are jumping around constantly as millions of people buy and sell. There are actually two main ways to make money from stocks. The first is what we already talked about: buy low, sell high. You buy a share for $50, wait until it's worth $80, and sell it for a $30 profit. The second way is dividends. Some companies, when they make profits, share a little bit of that profit with their shareholders every few months, like getting a small bonus check just for owning the stock. Not every company pays dividends. Younger, fast-growing companies usually reinvest their profits instead, but it's a nice perk when they do. Of course, stocks can also lose value, and this is the really important part. If a company does badly, or even if the whole economy hits a rough patch, your shares can drop a lot. Sometimes companies even go bankrupt, and the stock becomes worth basically zero. That's why people say investing in stocks is risky. The reward can be great, but you have to accept that the value bounces around, and on any given day, you might be down. This is why most smart investors don't put all their money into one company. They spread it across many different ones, so if one tanks, the others can balance things out. That's called diversification. The last big idea is time. Stocks tend to be wiggly and unpredictable day to day, but if you zoom way out, like 20 or 30 years, the overall stock market in healthy economies has historically gone up. Not in a straight line with plenty of scary drops along the way, but generally upward over the long run. That's why grown-ups often buy stocks for retirement. They're not trying to get rich next Tuesday, they're letting their money slowly grow over decades. Stocks are basically a bet that businesses on the whole will keep inventing, growing, and making more money over time. And when you own a piece of them, you grow along with them.